There is a 3-digit number that follows you everywhere. You've never seen it get calculated. You didn't agree to it. But right now, it's deciding whether you get an apartment, a car, a phone, sometimes even a job. It's a number between 300 and 850, and a machine you've never met updates it constantly. In the dark, using a file on you that you're not even allowed to fully see. This is the machine that decides your credit score. Let's open it up. First, the big misunderstanding. Your credit score is not a report card for being good with money. It doesn't care if you're rich. It doesn't care if you save. It measures exactly one thing: how likely you are to pay back borrowed money. Think of it as a prediction. Every point is the machine guessing. If a bank lends this person money, will they pay it back on time? High score means low risk. Low score means the machine thinks you might not pay. So what actually counts as good? Roughly this. Under 580, the machine flinches. That's poor. 580 to 669 is fair. 670 to 739 is good. And now you're finally normal. 740 to 799 is very good. And 800 and above is exceptional, where the machine rolls out the red carpet. Most doors open around 670, but the truly cheap money hides above 740. And here's the uncomfortable part. That prediction is a product. It gets sold to banks, landlords, and car dealers thousands of times a second, all over the country. You are not the customer. You are the thing being rated. And it's not just banks. Landlords check it before handing you the keys. Insurance companies use versions of it to set your premiums. Some employers even peek at a version before they hire you. This one quiet number is a background check that runs in the shadow of your entire adult life. So where does this number come from? To understand that, you have to meet the 3 companies that secretly keep a file on almost every adult in America. Their names are Equifax, Experian, and TransUnion. They're called credit bureaus. You never signed up with them. You can't quit them. And yet they've been quietly recording your financial life for years. Every credit card, every loan, every missed payment, every account you've ever opened. Your lenders report it all to these 3 companies every single month without asking you. But wait, if they have all the raw data, who turns it into the actual number? That's a separate company most people have never heard of, FICO. Back in the day, getting a loan meant sitting across from a loan officer who judged you by your handshake, your clothes, and far too often, your skin color. It was personal, slow, and deeply unfair. Then, in 1989, FICO released a formula. Feed in the data, out comes a single number. Suddenly, lending was fast, scalable, and, on paper, blind. The machine didn't see your face. It only saw your history. And that formula runs on 5 ingredients. FICO has told us the recipe, but not the exact math. Here's what actually moves your score, from biggest to smallest. Ingredient 1, and it's the giant. Payment history. 35% of your entire score is just one question. Do you pay on time? One payment, 30 days late, can drop a good score by 50 to 100 points, instantly. Ingredient 2, almost as huge. How much you owe. 30%, but not the raw dollars, the ratio. If your card's limit is $1,000 and you're carrying $900, the machine panics. That's called your utilization. Here's the rule. The machine never tells you out loud. Keep your balances under 30% of your limit. Under 10% is even better. Same spending, same card, but a maxed out card screams danger while a lightly used one whispers safe. Ingredient 3, the length of your history. 15%. The machine trusts age. A credit card you've had for 10 years is a decade of proof, which leads to a trap we'll come back to. Closing your oldest card can actually hurt you. Ingredient 4, your credit mix. 10%. The machine likes variety. A card here, a car loan there. It wants to see you can juggle different kinds of debt responsibly. And ingredient 5, new credit. 10%. Every time you apply for a new card or loan, it leaves a mark called a hard inquiry. Open 5 accounts in 1 month and the machine gets nervous. Why does this person suddenly need so much money? Now, put those 5 together and you find the cruelest paradox in all of personal finance. To prove you're trustworthy with debt, you must first go into debt. Picture someone who does everything your grandmother told you. No credit cards, no loans. Pays cash for everything. Owes nobody a cent. What's their credit score? Often, nothing. They're invisible. The machine has no file, so it assumes the worst. Meanwhile, someone juggling 4 credit cards, always paying the minimum on time, looks like a hero to the machine. Read that again. Being debt-free can score worse than being permanently in debt. The system doesn't reward saving. It rewards borrowing, carefully. Okay, let's kill some myths, because these cost people real points. Myth 1, checking your own score hurts it. False. When you check your score, that's a soft inquiry. It does absolutely nothing. Check it every day if you want. Myth 2. Closing a credit card helps your score. Usually the opposite. Close a card and you erase its age from your history and shrink your total available credit, which spikes that utilization ratio. 2 hits at once from one innocent click. Myth 3. Carrying a small balance and paying interest boosts your score. Complete fiction. You never have to pay the credit card companies a cent of interest to build a perfect score. Paying in full every month is ideal. That myth just makes the banks money. So what actually destroys a score? 3 things. In order of pain. A missed payment that goes 30 days late. Maxing out your cards. And the nuclear option, an account sent to collections, which can haunt your file for 7 years. 7 years. That's how long a single serious mistake sits on your record, quietly lowering the odds on every loan, every apartment, every deal, long after you've moved on. And let's put a real price tag on this number, because it is not abstract. Picture 2 people buying the exact same house, borrowing the exact same amount, on the same day. One has an excellent score. The other has a poor one. Over a 30-year mortgage, the person with the worst score can pay tens of thousands of dollars more in interest, sometimes well over $100,000 for the identical house. Same walls, same roof, same street. The only difference is the number a machine decided to give them. That is what these 3 little digits are actually worth. Now, here's the part that should make you angry. These 3 companies hold the most sensitive file on your entire life, and you never hired them, and you can't fire them. And they are not perfect. Studies have found that a huge share of credit reports contain errors, wrong balances, accounts that aren't yours, payments marked late that were on time, and the burden is on you to find the mistake and fight to fix it. And they get breached. In 2017, Equifax was hacked, exposing the personal data, social security numbers included, of about 147 million people, roughly half the adults in the country. The company that grades your trustworthiness couldn't keep your own data safe. So how do you actually win this game? Because it is a game, and once you know the 5 ingredients, you can play it on purpose. Here are the rules that move the number. Rule 1, the big one. Never ever miss a payment. Set everything to autopay for at least the minimum. This alone protects the 35% that matters most. 1 habit. More than a third of your score. Rule 2, keep your utilization low. Try to stay under 30% of every card's limit, and under 10 if you can. Paying your balance down before the statement closes is a quiet trick that can jump your score fast. Rule 3, keep your old cards alive. That ancient card you never use? Don't close it. Put 1 small subscription on it, set it to autopay, and let it quietly age like a fine wine, feeding your history length. Rule 4. Don't open a bunch of new accounts at once, especially right before you apply for something big like a mortgage. Space out your applications. Let the machine stay calm. Rule 5. Check your reports for free and dispute errors. By law, you can pull all 3, and fixing 1 wrong late payment can lift your score more than a year of perfect behavior. So here's the final truth about the machine. It was sold to us as fairness, a blind number that judges everyone the same. And in some ways, it is fairer than a biased loan officer. But never forget what it actually measures. Not how good you are with money, not how honest or hardworking or careful you are. It measures one thing, how profitable you are to lenders. The perfect customer isn't debt-free. The perfect customer borrows forever and always pays it back with interest. You can't opt out of the machine, but you can learn its rules and quietly beat it at its own game. Subscribe, because next, we're pulling apart the thing hiding inside every price tag you've ever paid. Why your money buys less every single year.